How's it going, YouTube? I'm Ari and welcome to Blue Lion Finance, a channel for the long-term dividend or value investor out there looking to create or continue to build a lasting passive income dividend investment portfolio. Initially, I began my journey back in 2019 with $3,000 invested into a Vanguard index fund before amassing a dividend investment portfolio that is now sitting just under $100,000 at $97,679.55. But as for today's video, just given the amount of uncertainty and fear in the market with earnings season underway, inflation that just popped to 9.1%, and an inverted yield curve, all strong indications of a recession to come, I thought I would just deliver through on some insanely reliable dividend stocks, 5 to be exact, and all of which are dividend kings, meaning they've been shelling out those dividends for over 50 years and increasing their dividends year over year. Now, before we get going, a little state of the union for everyone. The channel's name, Blue Lion Finance, will actually be changing to my actual name, Ari Gutman, and very soon, so keep that in mind. And oh, just before I actually forget, do me a favor and tapping on that thumbs up button. It certainly helps me out in growing this channel and getting the word out there. And most importantly, join me on this journey by subscribing to the channel. I'd love for each and every one of you to be on this journey with me. Now, YouTube, let's go ahead and dive right in. As I already shared, the market is essentially in utter ruins, and it's only really a matter of time before things get even worse. But don't worry, because during these market periods of total pandemonium, the long-term value investor actually fares very well. And a matter of fact, it's a time like right now to be doubling down on value stocks. Now, forget about the meme stocks, the gambling mentality, and the alike, and just keep to what works. Building wealth is really that simple. And in even better news, investing into the handful of stocks that we're about to dive into, these 5 dividend kings, will actually allow you to sleep easier at night knowing that their low betas and sheer reliability of these companies are just going to keep your hard-earned money safe. So with that said, our very first dividend king on the list today is Nucor, ticker symbol NUE, which is an American producer of steel that was founded back in 1940. Now, since its founding, Nucor has exponentially grown into what is today America's largest producer of steel, as well as the biggest recycler of scrap metals within all of North America. Of course, with such growth over time comes a market capitalization to follow at $29.19 billion. Now, it's interesting to think about both the bearish case and the bullish case here for Nucor, because on one hand, bearishly if you will, investors are worried about a recession, which rightfully so, but that means in the near term, demand for steel would essentially drop, resulting in a blow to Nucor's revenue, even with Biden's $1.2 trillion infrastructure bill. Now, on the other hand, not only will they perform well in the long term as a survivalist stock, but more recently, they have been repurchasing their own stock, $900 million in Q1 to another $803 million in Q2, resulting in a very strong capital return program for shareholders as we navigate this uncertain time together. Now, either which way, as we speak, their stock is down from a 52-week high of $187 per share, trading now for around $107 per share, roughly a 43% change, with their PE ratio at, get this, 3.9. That is an opportunity for those who have patience. Now, after all, it pays to be patient. When analysts are foreseeing a rebound but further growth ahead, it is time to jump in. Average share price $144 per share and a higher target share price of $190 per share. While it certainly may take some time for the stock to actually rebound, with those stock share buybacks along with a stable dividend with 50 years worth of dividend payments, you certainly won't have to worry much, as you can just kick back and collect on their dividend yield at 1.77%. As for our second dividend king, it is a time-tested, market storm weathering insurance company. We are talking about Cincinnati Financial, ticker symbol CINF, primarily offering property and casualty insurance. Now, Cincinnati Financial was founded back in 1950, and since their founding, they've amassed a market capitalization of $18.58 billion. Now, given it's just an insurance company generating its income through premiums, with a vast majority of their revenue generated through commercial lines, they're likely to continue to maintain their steady, though nominal growth at this point in time within their earnings. However, with all of this market volatility in such uncertain times, its stock share price has certainly been impacted, falling from its 52-week high of $143 per share, where it now trades for around $111 per share, which is a nice change of 22%. Now, regarding their PE ratio, it is currently sitting at 9.2. And interestingly to note here, hedge funds have been increasing their positions with Cincinnati Financial. Hedge funds like Ray Dalio's Bridgewater Associates to Gotham Asset Management, all meaning that a recession is very likely, and a lot of these firms are just looking to park their capital with a very safe investment like Cincinnati Financial. Now, not to mention all the growth to come, as analysts do foresee an average stock share price of $146.50 per share, and an even higher target share price here at $160 per share. Now, until it reaches these prices, investors can comfortably enjoy a very safe dividend with 62 years worth of a dividend history, and of course a dividend yield that is coming in at a very strong 2.24%. Moving right along to our third dividend king of the day, we have Target, ticker symbol TGT, which I know what already many of you are thinking, but Ari, what about Walmart, Amazon, Costco, Home Depot, Kroger, or Walgreens? And to that I say there is nothing wrong with going after some of those bigger retailers out there, but my personal preference lies with Target, even though it's only the 7th largest retailer as opposed to these other 6. Why? Because I personally am a fan of the brand that Target has been building over time. I mean, just think about it. When you think Target, you are getting a totally different type of customer over, say, your Walmart customer. You also have partnerships that they're building that speaks volumes to the quality of type of store that they are, from Starbucks to that tech titan out there, Apple. Not to mention no creepy greeters trying to capture you at the door. Now, in terms of their market capitalization, Target's market cap is sitting at $67.44 billion. And right now, of course, like all retailers across the board, they are experiencing the impact of a looming recession as consumers are becoming more conscious of their spending, if they're even shopping at all, which leads to higher inventories weighing on their corporate bottom line, all of which ultimately has led to their share price plummeting roughly 45% from a 52-week high of $268 per share down to $146 per share. However, keeping our focus on the long term, analysts are expecting a rebound to $180.79 a share, an even higher target share price at $210 per share. Though it could get worse before it gets better, what remains very clear to me is the opportunity to snatch a dividend king like Target up at such low valuations. And until an economic turnaround where the consumer is back at it, we can collect on Target's 2.46% dividend yield, with their dividend only ever increasing as it has been for the last 50 years. As for our fourth dividend king, it's one that I've actually spoken about pretty recently. I'll put the link above here to that video, but keep in mind I'm not here to be talking about and pitching you on these meme stocks, if you will, but rather lucrative long-term investments, which is why I'm talking about this one again. It is Stanley Black & Decker, ticker symbol SWK, a manufacturer of tools, household hardwares, and security products. While many of you may be tempted to go towards those home improvement retailers like Home Depot or Lowe's, I prefer to go right to the source here with the company that actually puts the product on their shelves for both of them. And Stanley Black & Decker has been doing so since their founding in 1843, bringing some top-notch brands to the market from DeWalt to Craftsman and Paladin. Their market capitalization has only blossomed during that time, currently sitting north of $16 billion. And even though Stanley Black & Decker isn't a retailer, they certainly have been feeling the pinches of a looming recession too, from the drop-off in customer spending, but even on a larger scale, an overall slowing of the economy, which means that construction and home improvement projects will ultimately slow down, all leading to their share price sliding from their 52-week high of $208 per share down to where it currently sits around $105 per share, which is about a whopping 50% change, and with a PE ratio at 12.9, quite a steal in my opinion for those who can practice some financial patience. Now, looking ahead, analysts see Stanley Black & Decker at an average stock share price of $150.75 and coming back up to an even higher target price here of $200 per share. The best part about investing into Stanley Black & Decker is, of course, that dividend. They've been shelling it out for at least 54 consecutive years, increasing it year over year, and their current dividend yield is sitting at 2.9%. Finally, last but not least, a dividend king that has never been spoken about on this channel before, so brace yourself. We have Black Hills Corporation, ticker symbol BKH, which is a diversified utility company providing both electric and gas to over 1.3 million customers throughout South Dakota, Montana, Wyoming, Colorado, Arkansas, Kansas, Nebraska, and Iowa. Since their founding back in 1941, Black Hills has amassed a market capitalization of just under $5 billion, and more recently has been experiencing growth. Interestingly enough, it has been getting involved in the crypto mining space that has actually come to represent some of the largest Bitcoin mining operations in the region. Just last quarter, their revenue soared by 30% year over year to $827 million, which I am sure is related to their rather recent involvement in that blockchain electric load service. Regardless, utility plays are usually ultra safe investments, given the simple fact that customers are just going to have to pay their electric bill or literally go off the grid.
This is how much we pay for electric?
Well, yeah.
And because of that type of reliability, its stock share price fell only nominally compared to some of the other kings on the list due to the overall market volatility. Nonetheless, it is down 11%, falling from its 52-week high of around $80 per share down to around $71 per share. Now, Black Hill's current PE ratio is hovering around 17.7, and with analysts forecasting an average share price of $79 per share with a higher target share price of $81 per share, it certainly may be well worth the add to your watch list, especially given that dividend yield of theirs is coming in at 3.27%. They've been shelling that out for 51 consecutive years, increasing it year over year. Now, YouTube, that is it from Nucor to Cincinnati Financial, Target to Stanley Black & Deckard and Black Hills, the 5 dividend kings that will continue to deliver through on dividend firepower for your dividend investment portfolio during these trying times. I'd certainly love to collect your thoughts on each of these companies if you have them within your portfolio. Perhaps you're thinking now of investing into them, or if you have better dividend kings on your mind, drop all those comments down below to let me know. Now, remember, I will be actually changing the name of my channel from Blue Lion Finance to Ari Gutman. Stay tuned for that. Keep in mind, I'm not a financial advisor, so always do your due diligence prior to making any major investment decisions following my videos. Of course, before we close out for today, tap on that thumbs up button and help me grow this channel. If you haven't already subscribed, make your way over to doing so. I'd love for each and every one of you to be on this journey with me. And until the next video, YouTube, I will see you all there.